So if you've been drawing trend lines but still losing, this is for you, because this will literally change everything. Today I'm giving you the full trend line strategy: entry, stop loss, take profit, step by step.
So don't go, leave me lonely, I'll show you another way.
So most traders draw trend lines the wrong way. Some draw them correctly, but they don't know how to turn them into profitable entries. In this video, I'll show you the exact trend line strategy that works on 3 time frames, keeps you disciplined, and helps you catch cleaner, higher probability moves. So the first step to doing this is to identify the trend. For this, I'll be using a new chart. You identify the trend using the ICI. The ICI is simply the impulse correct impulse. But if the market is choppy or ranging, you leave the marketplace. So this is a new chart. I'll go ahead and delete all markups on this before. Then we'll start just now. So the first step is for you to draw a clean, valid trend line using the previous criteria. This is on the 4-hour chart. So we want to see a trend line that took out that has previous high, or the previous high rather, because this is in the downtrend that price has been taking out previous lows and creating lower highs. If it's in an uptrend, we'll be looking for scenarios where price is taking out previous highs and creating higher lows. So for this, we want to look for 2 previous highs that took out 2 previous lows. Makes sense, right? So this is a high, and this is also a high. So, and these highs took out previous lows here. This low and this low. So we connect both of them. So this right here is the ICI, impulse. No, sorry. That's one. Open for a down move. We have this impulse, correct, impulse. You see it? So this is it. Impulse, correct, impulse. This high took out this low. This high took out this previous low. This high took out this low. And this high took out this low. So that's what we have this. So you don't have to force the line. The line shouldn't cut through candles. Though most people use that, but what I use is on the wicks. You don't want the line to cut through candles. And the edges have to be clear. Just like this too. So you also want to use the relevancy test to confirm the recency of the trend line and know if it will be used currently or if it will be discounted. So for this trend line here of ours, it's not anything closer to the current chart. We could use this one right here with this high, but if you check it, this high was supposed to take out this low. Price came here and created and took out this low, so it's not in line with much with what we've talked about just now. So for this reason, I'm going down to the 1-hour chart, which is the second time frame. There are 3 time frames to this rule: the 4 hours, the 1 hour, and the 15 minutes. The 15 minutes is entry and trade management. So what the other purpose we can use for this 4 hours time frame is to draw our support or resistance level and supply and demand levels also. So we can do that by using this right here. These are previous resistance we are waiting for price to come back to. And currently I'm not seeing any previous supply or demand level on this high. So this is the 1-hour chart, and the first thing we should do as usual is mark out the ICI. This was the corrective buy that led to this sell. So the first high is already marked out, so mark out the second high that took out the previous low here. This here is the recent low here. Why I use this and notice that this has a 3 candle pullback, I don't use previous lows or previous highs that have anything less than 3 candle pullbacks. So that's why I use that one there. So now, from here now, the next thing we should do is mark out the trend line, which is simply this high connected to this high here, and extend it out. You see that from here, price respected, this drop came back, this one, this was a close somewhere here, but the correction is here. Let's see, the correction is here. Then this drop, corrected again. Then this drop, corrected again, drop. Then a little range, pull back up, weak, and drop before another corrective buy happened again. So what basically do here is, after we've drawn these two highs, then we're going to draw the support and resistance levels. But the main thing I'm waiting for here is the third touch on the trend line, and I'm coming to that. So these are the support and resistance levels. So you see that from this break here, we didn't have much of a clear correction. This was one, but it ended up being a choppy reaction there until we had this correction here. So this is the third touch on the trend line, and this is the reason why I included support and resistance levels. Now this third touch doesn't always align with your market trend, market structure, because sometimes while you're waiting for price to return to the third bounce, price won't return there, and eventually when it does happen, sometimes it turns out to be lost. So that's why I use the support and resistance level to wait for reactions that are in line with market structure and not just the trend line. The trend line is a tool to tell you the trend, while your market structure tells you what the market is doing at the moment. So after this here, after this break, we had this correction here that led the price has tested this level already. So this correction was valid for a short. I also had this correction of retest here again for under shorts. But basically what you should be waiting for on the trend line is a third bounce, and the consequent ones after the third bounce, one that follow it, you can wait for them. But I don't really look into the bounce. What I look out for is price coming back to the support or resistance level. If price touches the trend line, then is all good, we go with it. But I actually wait for the previous support or resistance levels. So price might not touch the trend line, but it's still valid. You enter with a breakout, not the bounce. That's why I said it's valid. So entering with the breakout is simply you doing this. So from here now, you now head on to the 15 minutes time frame and do this. So these are those moves on the 1 hour chart. So after the first one, this is the ICI. You see the retest here, tested here, but failed to break. So because previous I wasn't taken out, you can also take the trade. So the following day, let me add my session. Let me spice it up a bit. So the following day, during the London session or New York session, you want to take this trade, but this one would have been something we would have missed out on, because this actually happened during the Tokyo session, and I don't trade Tokyo session, so we would have missed out on this one. It was a very good move, and that's also another thing. Now you're waiting for the third bounce, and the third bounce eventually happened. It's outside the session. This is actually okay. I would have been awake by this time, but not on the chart. Like actively ready and waiting to place trade. Every criteria met here. The risk to reward, the setup, the retest, everything, the entry, breakout, it all met, but it's not in my session. So I'll pass on this one. I'll really pass on this one. So coming back here, you now wait up to the New York session to take the next trade, and probably it doesn't align much. Okay, it does align, but this trend line isn't with it. This trend line isn't aligned with it. So what you enter with here is your market structure. You enter with the MS break. So while waiting for the third touch, you don't just wait for the third touch and once you see the third touch, you take your trade. No. When you're waiting for the third touch, when the third touch eventually happens, what you wait for is to see the MS and CTL break. The MS is simply market structure break, and the CTL is also the counter trend line break. Now this is the counter trend line break I'm talking about, and this is the MS break I'm talking about. So So while you're waiting for the MS break, what you actually do is you look at your session. That's when you calculate your SL and basically some other stuff. So your SL, your risk to reward, and see if the trade is even worth taking. So if the MS breaks first, like in this case I'll have you enter on the close of the candle that breaks out from the market structure, which is here, this candle right here. So this would have been the entry, and with this setup, probably the other side would have been somewhere here. Judging from here, somewhere here, around 15% to it, this should be around, say, 14 to maybe 15 pips stop loss. So 15. If you come around here, you should have at least more than 1:2 on this trade, because you are aiming for this low here, for this low right here. But this is a New York trade, and mostly New York trades that I take actually hold on into the following day. So you see, this would have been a trade that's 15, probably 1:3 or more on this trade. 1:3 or 1:4 on this trade here. So after this, you extend the trend line again, and once again it has failed the relevancy test. So you pull up on that trend line here, just right up here, using the same rule, using the same ICI, impulse correct impulse. Now this high here took out a low here, and this previous high took out a previous low also here. So you just pull up the trend line, do the same. So you do the same thing and extend the trend line once again. So from here now, you have this trend line here and this previous low right here. But after price breaks out of this low, price no longer respects this market structure here, this one that is inside this range, but breaks out and respects this one. So from this one now, you have your third touch here and your next sell. But then this next sell is also, this next sell will also break out of, or also be out of this trend line, something like that. So let's go down to the 15 minutes chart and also look at this. So now this is the third touch on the 15 minutes time frame, and coming here now, there's no entry because retracement here is not clear and it's not what you want to see. You can't actually read this trend unless you drill onto the 15 minutes chart, and unless you drill onto the 5 minutes chart, and we don't use the 5 minutes chart. So for that reason, we pass on this one also. So then when you return back to the 1 hour chart, you now extend the trend line again because the trend line has broken, has lost the relevancy test, its relevancy or recency. So you extend the trend line again. Even if the time frame or the session is correct, the correction here is not clear. And I'm not seeing something like this here. So let's jump to the 5 minutes chart, like you might see it. It's when you jump to the 5 minutes chart, I can actually see the correction inside there, like the market structure correction inside there. So once again, the trend has failed the relevancy test again, and we also have to extend it. So I'll just be doing this on the 15 minutes chart and pull it up again. So probably this day have passed or has passed rather, so we extend to the following day, and this is just how you keep extending the trend line to meet the current market structure, because it's a tool that tells you the current market trend. It's not specifically a tool telling you when to buy or when to sell. You're actually using the market structure to do that, but the trend line is telling you the current trend that you are on and what your actions should be. I know coming out here, it should be like somewhere here. It should be like, oh, trend line is broken, we should start buying from here. But if you also check it, the previous high, which was here, because this last high here wasn't broken, it wasn't taken out. So you should not start looking for buys from here. You should only look for buys when this high that came here failed to create a lower low, which is this. Let's say this high that came here, this something like this here. from this high, did something like this here, failed here, then came above here and took out this high. Even after it has taken out this high, it's not really telling you that you start buying. Once you see price do something like this and take out this previous high here, close above it, and it might not happen with one move. It might happen like this here, then retest and take out this high. So once you see this one now, you should now be like, okay, now the market has changed direction and I can start buying upon the next retest from the previous support level. You see it. That's basically how this thing works. So you should understand market structure in depth for you to be able to use this strategy or system to work. So what you're actually waiting for is you're waiting for price to return to these levels before you can look for a trade. So there's a break here and price is actually on this level, and we'll scout for a setup somewhat around here. And now we have a setup here, but now the setup doesn't happen within our session. It happens outside. It doesn't happen within our trend line. It happens outside our trend line, like after or outside the trend line break. That's why I say that you should not be like, since price has broken out on 15 minutes, you should start buying. You should only start buying when you see the previous 1 hour high being taken out. This caused me lots of losses before. So from here now, we have a trend that is clear. We have this impulse correct, and a little range inside here, and this caused this impulse. But this impulse from here failed to take out this high. This sign that buyers are getting weak and sellers are coming to the market. So you take a trend line from here. You can actually take it like this, but this one is no longer relevant to the current chart. So you put it across like this. You could keep it here. There's no perfect or undrawing a trend line. It means that the trend line follows market structure. That is the main thing they're looking for. So from here now, we have this trend line. This is our CTL break here, our counter trend line break. Then we are waiting for MS break here. So that is it. This is what we're waiting for. So now when you want to enter, the MS break happened here. Your stop loss will be above this high. This is too much. You actually want to learn how to play your risk to reward game really well, because it will change a lot in your PNL and your entire account metrics. So from here now, this 13 pips, you could make it for a round figure and aim for 28 pips. I think I took this trade, but something made me not to exit. I was expecting price to take out this low on this day, which wasn't wrong, because it's actually what price does, but for some reason price didn't take out this low. I entered this trade with a 10 pips stop loss, and my TP was somewhere around here, 20 pips. Yes, I could recall, but for some reason price didn't come back here. I don't know, but price didn't get to this low, which I was targeting. If I had gotten to this low, I'd have made at least 1:4. I could remember it was a 40 pip take profit. So I was actually aiming for the 1:4. Then there's something that I do that I'll also show you here. Now this a trade management rule or criteria that helps you safeguard your capital, or rather protect your capital, because your main goal here is to make money while also protecting your capital. So there's this rule that I use that has been helping me lately. So the rule is actually this: when this trade now is in 1:1 profit, because currently this is a 40 pips stop loss. So when this trade is at 40 pips from here, 14 pips, you check down here. This when it was at 18, and this when it was at 14. When the trade came to 14 pips, you should do something. When it comes to 14 pips, this your stop loss, you reduce it to half of your initial SL. For your 14 pips, you should take your stop loss down to 7 pips. So even if your trade whipsaws, you are not losing your entire account, you are losing half of it. Then eventually, while you are waiting for the 14 pips, when price now gets to 1:1.5, most will be 1:2, 1:1.5 of your stop loss. 1:1.5 is simply you bringing 14 pips, which is your initial stop loss, at 1:1, then adding 7 pips to it, which is the half of your stop loss. So 14 plus 7, that should be 21 pips. So from 21 pips here, when you get to 21 pips, which it actually got to, but it should have taken, well, let me see. Okay, since the price got to 21 pips before testing to cause this flash up here. So when price when price go to 21 pips, you break even completely. You are no longer having any risk on this trade. So the amount you're risking there is completely free. Then that time there will be no stop loss here in your MT5 platform. Your stop loss will be below your entry threshold. You see what it does? So for whatever reason, even if you trade whipsaws, your your capital, the amount you're risking is completely covered. Like you're losing nothing. So instead of you losing, you are making something. It could be in cents, or probably, let's say, a few dollars, but it's something. Because on a trade that actually whipsawed and went against you, you didn't lose. You didn't lose nothing. Rather, you made small profits. So it's something. So this is actually a tremendous skill, and it's mechanical. It's not discretionary that you are. So it is actually fully discretionary, and it's not something like you work with your emotions. It's fixed. Once it gets to 1:1, no emotions, I have the SL. Once it gets to 1:1.5, no emotions, I break even, no matter where the trade is at the moment or wherever it is. So on this day, I was actually aiming for this, but price came back and took out my. It's like it was my break even or my half SL, something like that. I can't recall clearly. But after it took me out, it later came back. It didn't also miss my take profit here, but it came back to something better. So that's that for that. Now after that one, there's also another setup here again. The following day, it stuff happened during London session. So now, if you look at the market structure here, you know that this trend line here is still valid and can still work here. Why? Because price hasn't taken out any previous high here to create a new higher low. It's still within this range here. So this trend line can still work perfectly well within this range. So extending it out again, now you can now work with a new what I call it, market structure break, a new MSB, but still the same CTF but adjust. So now the MS, because we're looking for faster entries, the MS should be somewhere here. Yeah, it should be somewhere here, because if you look at it clearly, this was a downtrend. Yes, this is an impulse correct. Price broke out of this high. So using this low here, if price breaks out of this low again, you are looking to short fully. You see it. So now your stop loss should also be somewhere around. Your stop loss should be this. Trades like this actually use sell stops to get on them. Sorry about that. Your stop loss should be somewhere here. I'll set the sell stop here. Your stop loss should be somewhere here. So around here. At this high, yes, this should be 20 pips. 20 pips, then you add your 15 pips stop loss, you should be around 23 or so. Then there's also something I'll also teach you here. For trades like this, that the retracement didn't go far enough into the previous range. What do I mean? Look at the previous range here. This is the previous range. The retracement didn't go far enough into this previous support level. Now you're wondering, how will I target this low? Because my risk to reward here doesn't make sense. Now what you do is simply this. But before then, let me extend the trend line again to meet the current recency or something like that. So the trend line should be here now. That's why I said that I don't actually do much of having my mind on the third bounce. But this is actually a third bounce. This is Well, that's the first one, this is the second one, this is the third one. So go back to the 15 minutes again. So when you're stuck with something like this is basically what you should do. You measure the range of the retracement. This retracement is actually 66 pips. Divide it by 2. This is 66 pips. Divide it by 2. That's 33 pips. Then add it to the 66 pips and extend it forward. So 66 plus 33, that is 99 pips. That is the range there. So you extend this range to 99 pips and set your stop and set your take profits within that range. Now if you extend your trade to around 99 pips, you have your 1 to 2.5. It goes to 2.5. Do you see? Now this is where you know that markets can get to. So you set your stop loss and whatever within this range. You don't want to be outside. You see that after price hit the take profit, it's corrected before it actually started falling again. So this is just within the London session trade. So as usual, you bring this down here. When you're in 1:1 profit, you reduce it from 23 to 12.5, and you're risking less. And when it's full profit, you break even completely and you're risk free. And when it's 1:1.5 profit, you break even completely and you're risk free. Now the rules to know if your setup is invalidated, I mentioned some of them before. One of them is actually if this risk to reward is off and you also use measured move. I call this the measured move. I also use this measured move strategy and it's also off. You sit out. If the correction isn't in line isn't in line of a trend, it doesn't look like a trend, a corrective trend, you sit out. There are many more, but I'll add them at the end of the video, so watch to the end so you can have to get them. So if this content that you like and you probably enjoyed this one and I'd like to see more of it, hit subscribe and like the video, because more of this and stuff like this and more explanations on trading are coming. So you could make your suggestions of videos you want to make for you in the comment section. Peace.